Rajiv, great to have you with us here. Prashant this side, and good to see you. Now, I want to start with, Rajiv, what you put out in a note recently, where you are advising caution as far as mid-caps or small caps are concerned. I think you used the example of what's happened with the SME space, where from the recent highs, the SME index is down about 12% or so. And you're saying that for mid and small caps as well, one needs to exercise some caution here. Could you explain to kick this off, Rajiv?
Thanks, Prashant, and thanks for having me back. So if we look right now, why market is rallying so much? It is rallying because of sentiment, that is liquidity. So we need to track where this retail or this liquidity is primarily sitting in right now, and that is largely in also in SME side. So that's where some of the hit has started coming through, and we have seen close to 14 to 15% kind of a decline since end August onwards. So now if there is a loss of liquidity or a capital in this scheme of thing at the same point of time when you are seeing more issuances in IPO and additional side coming up, that's where the money which was chasing your small and mid cap or even the broader market will start going into a bit on the sideline or bit start getting fearsome. We are not that situation yet over here, but looking at the pipeline which is building up both on IPOs as well as additional issuances side, saying a lot of liquidity will sucked out, and if liquidity has to come out, then most expensive spaces, small and mid cap, and that can go in a correction kind of a mode.
Rajiv, just to take that point forward, I believe in that note you are calling for about an 8 to 10% sort of a downside on the small and mid cap space. I mean, some would argue that maybe that's not too bad. That's the kind of cool off that the space needs. What would you advise? I mean, is the general sense that this is a time to stay away, or should you go back in when this dip happens?
So post-COVID, we have seen that the correction duration as well as correction size is reducing, and 8 to 10% is a legible way we can look forward for. Now, in a market where my domestic investors or retail are having a huge position in the small and mid-cap space, the better idea for them would be not to chase the rally, to buy the dip, or to start looking at a weaker time movement which will come. But this will be an opportune time for the first time investors or even the foreign investor who missed the entire rally in India for the last couple of years. So when they are seeing any quality names are seeing a sizable kind of a correction, which we have witnessed last week during couple of days, that's where they can deploy the money and start making investment into the Indian equities.
Hi Rajiv, Nigel on this side, wishing you and your team a very, very good conference in the next couple of days or so. Rajiv, but you know, every time someone says turn a little bit cautious on India, we thumb the table and say that earnings are in our support and we're going to outgrow the rest of the world in terms of earnings. But we've gone past the first quarter, and looking at your note, there were some downgrades as well from the broader markets. What kind of earnings are you all factoring in, first on the Nifty in this year? And also, do you think that there are far more misses than hits from the broader markets as well?
So thanks, Nigel. And rightly you pointed out, earnings have been the key, and that is the reason why India has rallied 660% over the last 2 decades and outperformed US, which has only rallied only 440%. And that's largely because of an earning. But FY25 have not started on a great note. First quarter earnings was lackluster, and we anticipate even second quarter earnings are going to be subdued enough. Definitely there will be a lot of push and pull. Here the extreme heat waves as a which has hit demand will be replaced by your torrential rainfall, which will also impact the demand. But there will be some support coming from government spending rising post-election, and top of it, rural economy is showing signs of coming back over there. But the problem which is also coming is from urban spending side, where we are seeing four-wheeler demand taking a hit, hotel occupancy rates which are down, white-collar employment is taking a hit. So we are in a kind of a late cycle based on our QMI indicator, and this usually occurs once in a 2 to 3 years. So we anticipate this phase could last for earnings for the next 3 months. Talking about the growth for FY25, we are in the range of 12 to 15%. And we do anticipate the comeback of earnings will happen from third quarter onward. But the right way, when the second quarter approach from October 11, where people need to watch earning, you should not watch on YOY basis, because that's where, because of base effect, and as I told about some idiosyncratic factor, will lead some disappointment. So the better way to watch will be on the ask rate. With the pending 3 quarters left, and you have a certain expectation for FY25, see how the run rate is carrying on. If run rate meets, then a sector or a stock should benefit. Then largely on the small and the mid-cap side, we have seen close to 52 stocks out of 89, whereas consensus estimates are available. We have seen earnings downgrade happen post result season. Similarly, on the small cap side, close to 40 odd name out of 79 name have seen earnings downgrade. So that's where some comfort is going away, and hence we are broadly cautiously optimistic on markets near-term basis.
All right, Rajiv, we'll leave it there. Great conversation. Appreciate you joining us this morning here, and we will touch base, through the course of the day with your team members, and of course hope to have you back at the end of the conference to give us a sense of the learnings from the conference and what you heard. Thank you very much for being with us here on CNBC-TV18.
Thanks, Prashant. Thank you, everyone.
Deal Street is buzzing in India like never before, I can say. And who else but the big boss lady from Wall Street to give us her view on the way things are shaping up here in India. Thank you for making time. And that's really the big question. I'll actually start with the India question, because we're seeing such hectic activity, maybe less on the M&A side, but a lot in the secondary market on the equity side. How do you find India? How's your day one at the conference, and what's the feeling?
Yeah, very excited to be here and very excited to be back here after a year. And the mood continues to be better. Last year when I was here, I thought it was pretty robust. And if possible, this year it's even more buoyant than it was last year. And as you correctly say, the activity in the equity capital markets here have been extremely high. So the previous high water mark was in 2021. And this year already there has been more issuances than the full year of 21. And so we're very optimistic, not just about this year and but also the next year, and our pipeline is the best that it has ever been. And there's a lot of drivers for this, right? Because when you step back and look, the combination of what is happening domestically in India, as well as several multinational companies who have a large India presence, wanting an acquisition currency in India. So they're using this as the right time to have a currency which enhances their ability for future optionality. When you look at across the globe, areas of growth, as well as where there is a depth and richness of capital markets, this is now an over 5 trillion valued equity capital market.
Yeah.
And the growth that you've seen has also been tremendous. Even in the M&A market, the previous decade was at about a $70 billion average. This decade has been a $140 billion average. And that trend, as you have more companies investing in India, more companies with an acquisition currency in India, we really see kind of 4 different tracks of activity.
Okay.
One is kind of India for India, which is driving a lot of consumption. Then that is Make in India, so the exports part of it.
Right.
Then the tremendous investment in infrastructure, particularly digital infrastructure.
Yes.
As well as the fourth piece is all these currencies that are getting created, as well as domestic activity. Because earlier when we were selling a business, you were really looking at either the financial sponsor community, which is extremely active in India, and tremendous amount of money coming into India from sponsors. Is when you look at all of Asia, the 2 areas that financial sponsors are putting money into is India and Japan. In addition to that, for the first time, we also see when we are selling an asset, we have a domestic Indian company as a buyer for these assets. Because everybody is looking at the valuation and saying, I can afford to pay 20 times or 25 times because I myself trade at 30 times or north of it.
When so-called smart insiders start selling, whether it's private equity or promoters or early sponsors, when they start selling, is it reason to be cautious, or is it just sign of a maturing market?
Yeah, I think it is a sign also of what is the underlying fundamentals, because valuation is related to that, right? So what is driving that valuation is as important as where the valuation is. So if it is based on the earnings of the company, it's also based on the domestic amount of capital through SIPs that is going into the equity market. So when you look at the inflows are actually pretty high.
Yes.
But then you look at the percentage of domestic household income that is going into equities, it's still a very small percentage compared to most of the kind of rich countries or, you know, Western world or whatever you want to call it, as a percentage of how much money goes into the equity market.
Right.
So as long as the fundamentals continue to be strong, and as long as you have areas like this, the manufacturing growth continues to be there, digital infrastructure continues to grow, then the fundamentals support the valuation.
Okay.
So the way that...
so you're not sounding too concerned about you know, how companies are quoting at, or how, you know, the valuations at which deals are happening here in India?
No.
Okay.
Because currently it is supported by fundamentals.
Okay.
And so I think that's what we keep watching to say, does the underlying fundamentals support the valuation?
The global backdrop to all of this, because we speak when the rate cutting cycle is finally kicked off in the US, there's also politics. So just let's start with what lower rates are in general going to mean for the overall global M&A landscape and for emerging markets like India or Asia. What do you see ahead?
So I think the expectation of the Fed rate cut was fairly well telegraphed, and the market had built that into it. There is further expectation as well, which also the market has built in. So that's generally healthy, because that means you feel better about inflation, and that's what makes the Fed confident to do that. So the cost of doing deals becomes lower, which should enable more deal activity in theory, right?
Sure.
So financing was always available, but the cost of that financing has gone a little bit better. And when you look particularly at the overall global M&A market, strategic activity is back to 90% of historical averages. Sponsor activity, which is much more influenced by the interest rates, is at 60% of historical levels. So all the pent-up activity from the sponsor side, if that comes back online in 25 and 26, that should prove very valuable. That's not been the case here in India, but more globally, sponsor activity has been more limited.
So now we have to cover two more interesting subjects.
Sure.
One is obviously AI and this
Yes.
huge disruption that's playing out across the world. What do you think it will mean in terms of you know, deal activity or issuances for not just the world, but markets like India?
So I am very excited about the possibilities of AI, both as a personal user as well as the possibilities it has for our business and the possibilities it has for our clients. This could be a game changer. Right now, the number one topic that boards in global companies are talking about is the impact that AI is going to have on their own businesses. We ourselves are testing several LLM suites, about 400 different ones in our investment banking business, to try and see how it is that we can use that. Because the data is vast. The organization of the data is very limited. So if you can organize the data and draw conclusions from it, that can be powerful.
Sure.
In terms of providing insights.
So the other hot subject that we must get your view on is obviously U.S. elections, right?
Yes.
So while the debates will continue and, you know, the estimates will keep swinging, what impact? I mean, will it dramatically have any meaningful impact, irrespective of the outcome, whether it's Republican or Democrat?
So usually...
For markets and in general, you know,
so usually in election year, there is not dramatically reduced or increased activity. There are, you know, idiosyncrasies when there's an expectation of some tax change one way or the other, but the overall M&A volumes in an election year is kind of in line with other years, right? So there's not a material change. Places where you could have change, or the biggest debated areas, are antitrust, because the antitrust and regulatory framework and the unpredictability of it has been one of the impediments to deal making. And so that is an open question in terms of, you know, is it going to be the same? Is it going to be different?
Sure.
And it's not even whether it's restrictive or expansionary, it's just, can you predict it?
Sure.
right? Do you have a good sense of it?
If I were to ask you to take a crystal ball and look forward into the next 12 to 15 months, talk about secondary market activity or M&A, deals in general, in Asia and in India in particular, what would you say would be the hottest sectors?
So I view in Asia as India to be the brightest spot within Asia, and Japan to be the other kind of country. And so we are very heavily invested and rooting for it. And sectors-wise, I'd say digital infrastructure, energy transition, as well as multinational companies monetizing.
All right, we'll watch it for those trends. Thank you very much for joining in and giving us
my
perspective
pleasure
on all of these issues. Thanks very much.
Let's get you a CNBC-TV18 exclusive conversation now from the sidelines of the JPMorgan India Investor Summit. Now we're being joined by Ankur Rudra, who's the head of APAC Telecoms and India TMT Research at JPMorgan. Ankur, always a pleasure speaking with you, and you've joined us at an opportune time, largely because there's so much which is happening in the telecom space itself, especially ever since, the Supreme Court verdict did come by. So in light of that itself, we'd like your thoughts first on, the industry as it were right now, and in that, your call on individual stocks, namely Bharti Airtel and Hexacom along with Indus Towers.
Thank you for having me. So, the telecom space in India definitely has been looking a lot more brighter over the last, couple of years. And what we are continuing to see this year is among the several markets across Asia Pacific, India is one of the strongest, where we have seen continuous telecom tariff repair and along with that ROIC repair, which bodes well for many of the telcos over here. And I think that is one of the key drivers of revenue growth, EBITDA, and earnings momentum that will move on for the next 2 or 3 years. I think one of the things which is sort of stark about India is we are seeing 5G capex build out is past its peak. The key leading telcos have already completed most of their initial peak of capex, and hence going forward, capex intensity will fall. Along with this, because of tariff repair, you will see a relatively strong growth on revenues and EBITDA also. So the combination of revenues going up and capex going down is quite positive, which is sort of making this market really stand out. If I look at telecoms across the world and across Asia, India really stands out in that on that regard, and hence looks a lot more attractive. I'm sorry, I will not be able to talk about individual names, but on an overall basis, we definitely find is very attractive.
All right. Hi, Ankur. Good to see you in. This is Nigel on this side. So you're sounding quite optimistic about the telco companies itself. But what are you factoring in? A duopoly, or do you think it'll be a 3-player market?
I think what we are seeing is there is definitely a lot more investment by more players now than just the 2 leading players, and that might help the market stay less than or let me say market stay more fragmented, and incremental consolidation may not happen to the same extent it has happened in the past. If anything, one would have seen, if you look at the evolution of the level of market consolidation, if you look at, for example, the Herfindahl-Hirschman index, or the HHI index for India, it's been rising very rapidly in the last 5-6 years, but has slowed down a bit in the last couple of years, despite the fact that capex was extremely consolidated, right? Just a few players were doing most of the capex. As that gets a bit more fragmented, as capex is spread out by other players also, I mean, not just the top 2, but also including the SOE, I think the ability for the market structure to remain the way it is right now is higher, as opposed to market structure continue to consolidate going forward.
Right. On the telecom sector itself, just before we move on to other things, we had a lot of experts tell us that they're factoring in further 20-25% price hikes. Just wanted to know if there is enough demand to sustain this 20-25% sort of price hike over the next 18 months or so, because there has already been an increase, and we've seen a decline in the number of users, etc. as well. Just wanted to understand if there is enough consumer demand to be able to absorb that 20-25% price hike.
No, I think it's a very valid question. What we've seen so far this year, the level of tariff increases eventually was actually a bit below what we were expecting and what the market was expecting. We had previously factored in a tariff hike in the region of around 20 to 25%. I think the street had also baked that in earlier. Eventually, what we saw is the tariff hike was effectively around mid to late teens, 15 to 17% for some of the incumbents, and 18 to 20% for one of the incumbents. So as a result of this, the tariff increase this time has been slightly lower than what people were expecting, maybe leaves a bit more room to take another tariff hike, maybe another 12 to 18 months from now. Secondly, also the tariff increases have been a bit more graded. It's not equal at the lower parts. If you look at, for example, the entry-level phones or the feature phones, the extent of tariff increase is a lot lower, which makes it easier to absorb at those parts. And the tariff increases sort of tend to go up a bit more when you look at the smartphone segment. And of course, on the 5G side, the entry-level tariffs have been taken up even more. So the graded tariff increases this time does leave some room for another tariff hike. What we've currently built in is another 10 to 15% tariff increase next year. We haven't built in tariff hikes after that. Now, in the context of pricing, if you look at the telecom spending as percentage of GDP, if you look at the ARPU, value, the pricing for data, and in general, India remains among the much more, I would say, reasonably priced markets across the EM overall, and that gives you some space of increasing it a bit more. The churn, we've seen 1 month of churn, like you highlighted. The telcos which have taken a tariff increase have seen a churn in favor of the away from them, and the telco which has not taken any churn has done some capex recently, has gained some. So what we'll have to see is if this sustains, beyond 1 or 2 months, if the network quality is improving for the fourth telco also, in which case there could be potential risks of churn. But if it does not, because we've seen a lot of capex by the other guys, if the quality is not as good, some of this churn might actually come back. So we'll have to come and eventually see if the level of SIM consolidation, down trading, when the numbers come out for 2Q, is high enough to get worried about ability to take another tariff hike in the next 18 months.
Okay, all right. Ankur, I wanted your comment on this space, which is getting a lot of attention. Zomato has done very, very well, could potentially enter the Nifty as well, so the street is abuzz. And in the unlisted market, people are looking forward to Swiggy's IPO. How do you see the trade-off between the two and your view on this space?
Again, apologies, I will not be able to talk about any individual names, but what I would say is that we definitely like the food delivery and quick commerce space. We are definitely finding that quick commerce as a category is disrupting several retail channels, including modern trade and e-commerce. And as a result, the category will keep growing very, very sharply. Our recent research, we've highlighted that quick commerce operators have already become more than 50% of overall online grocery. The category expansion that is happening into newer categories beyond just food and grocery, into beauty and personal care, into electronics, appliances, toys, seasonal products is being very, very sharp and very strong. A much higher proportion of the gross order value or the order basket is expanding to these categories, which is not only increasing the average order values and hence improving profitability, but also increasing the use case for the category. So I think that we feel is a structural trend, and hence growth will continue to be very strong. On the food delivery side, growth has surprised us. We were expecting growth to slow down to mid to late teens by this year. It's continued to be at 30%, which was a big surprise. We think going forward now, food delivery growth can sustain about 20%, and that would be attractive. So what we find on the food delivery side, it's a bit more mature business, about 20% growth, but EBITDA margins can keep expanding because of operating leverage on indirect costs, whereas quick commerce will remain on disruptive, potentially exponential growth for a few years from now.
So while the opportunity is there is intense competition out here as well. So what does that mean for QCom in particular? And for the leader here, food delivery QCom leader here, there is that optionality of the going out business as well. Have you ascribed any sort of value to that?
Yeah, again, we'll not be able to make any comments about one specific company, but from a category overall perspective, the success of quick commerce, from the quick commerce, let's call it insurgence on the Indian retail landscape, right? There are 3 to 4 new companies which have built this category and which sort of taking share away from traditional modern trade, traditional e-commerce. They've obviously created much more scale, space in this. 90% market share is with them. The existing e-commerce players are we feel they're probably threatened by this, and as a result of this, we are seeing potentially defensive launches by e-commerce companies to protect their turf to an extent, because a lot of the new categories that they are very strong at, electronics, appliances, potentially are under threat. And hence, I think the next 1 year will be very interesting.